Welcome to our deep dive into the 2026 market landscape. Today, we're breaking down 7 of the most influential symbols in the tech and growth sectors. Whether you're a seasoned investor or just looking to understand the trends shaping the market, this breakdown will give you actionable insights for 2026 and beyond. Let's start with Apple. The stock has cooled off recently, pulling back about 7% over the last month. Investors are digesting what some are calling a valuation reset, as the price to earnings multiple feels a bit stretched compared to moderate growth expectations. On the bull side, Apple is riding the Apple Intelligence supercycle. Operating cash flow recently hit nearly $54 billion, and services revenue climbed to a record $30 billion. The integration of AI across iOS could spark a global hardware upgrade, and long-term brand loyalty gives Apple a defensive floor. But the bear case isn't trivial. Stagnating iPhone growth in China and ongoing regulatory pressure on the App Store could weigh on margins. If AI features don't drive immediate sales, sustaining that 250 plus price point may be tough amid rising production costs. As we leave Apple behind, we shift our focus from hardware to the king of AI chips, NVIDIA. NVIDIA has been the sun that the market orbits, trading near $178 after a staggering 58% gain over the past year. Recently, the stock has swung between valuation fatigue and blowout earnings, following a massive 73% year-over-year revenue jump. Bulls see NVIDIA as the undisputed AI king, with over $90 billion in free cash flow and a 90% share of the data center market. NVIDIA isn't just selling chips, it's building the infrastructure of the AI future. On the flip side, the bear case warns of over-earning. Some analysts suggest the stock could be as much as 33% overvalued if big tech slows AI capital expenditure. The long-term question: can the world keep consuming $200 billion in chips annually without a slowdown? From AI infrastructure, we move to enterprise software with Microsoft, a company feeling both the pressure and opportunity of this AI era. Microsoft is down roughly 14% year-to-date, entering rare oversold territory as the SaaS apocalypse sentiment hits the software sector. A large driver is the company's massive capital expenditure plans, projected to hit $200 billion by 2027 to build AI data centers. Bulls argue this is a generational buying opportunity. Microsoft is the picks and shovels play for enterprise AI, with Azure gaining ground on AWS. Analysts like Jefferies even set a $675 price target, seeing Copilot revenue as the future driver. The bear case, however, focuses on margin pressure. If Azure growth moderates or Copilot revenue lags, the stock could test support levels near $325. Next, we pivot from enterprise AI to the high volatility fintech space with SoFi. SoFi has been one of the market's wild cards this year, recently jumping 8% on news of a stablecoin partnership with MasterCard and AVGO. The company is evolving from a student loan provider into a diversified financial powerhouse. Bulls love SoFi's one-stop-shop model, which is growing 4 times faster than peers. With 2026 revenue guidance of $4.6 billion and a 34% margin, many see the stock as a steal. The bear case focuses on interest rate sensitivity and credit risk. A downturn could lead to higher personal loan defaults. Long term, it's a question of scale. Can SoFi become a top 10 global bank or remain a niche fintech sensitive to every Fed move? From fintech, we return to hardware, but this time behind the scenes, with Celestica, Celestica has been a stealth winner in the AI boom, though the stock recently dropped 14% over 10 days as traders booked profits. The company manufactures critical data center hardware, acting as a behind-the-scenes engine of AI. The bull case is fueled by strong earnings. Adjusted EPS grew over 50% last year, and a planned $1 billion investment in AI infrastructure for 2026. Revenue is projected to grow nearly 40% this year, making the pullback appear healthy. But there's risk. Stock gains of 3,000% over 5 years have stretched technicals, and short interest is high. Any hiccup in supply chains or reduced demand from hyperscaler clients could hit hard. Next, we pivot to Broadcom, a networking powerhouse benefiting from AI expansion. Broadcom surged recently after a Q1 beat with $19.3 billion in sales and a new $10 billion share buyback. Bulls see Broadcom as the toll booth of AI networking, with nearly every data center needing their chips to move data efficiently. Some analysts peg fair value near $450, leaving upside potential. The bear case? Extreme customer concentration. Just a few hyperscalers make up most revenue, so any shift toward in-house chips could stall growth. Add a high debt load from acquisitions, and investors must weigh risk versus dominance. Finally, we close with AMD, NVIDIA's main AI rival. AMD is about 25% below recent highs despite a strong guidance beat. It's positioned as the primary alternative to NVIDIA in the AI chip space. Bulls point to MI300X chips and a massive deal with Meta. If AMD maintains 35% revenue growth, analysts project a potential $1 trillion market cap in 5 years. The bear case is valuation. AMD trades at a higher forward PE than NVIDIA, 67 times versus 45 times, which raises questions given NVIDIA's stronger software moat. Long-term, AMD's success depends on securing the number 2 spot in data centers and staying competitive in laptops and desktops against Intel. There you have it, 7 of the most influential symbols shaping the 2026 market landscape. From Apple's AI-driven ecosystem to NVIDIA's chip dominance, Microsoft's enterprise play, SoFi's fintech evolution, and the hardware backbone of Celestica, Broadcom, and AMD, each stock tells a unique story of opportunity and risk. As always, these insights are meant to inform, not dictate your investment decisions. Keep an eye on the long-term trends and remember that the best portfolios are built with both growth potential and risk management in mind.